Okay, so in this example, I'm going to go ahead and explain how do we book fixed assets, and more importantly, how we depreciate for them. Depreciation is the recognition of the expense that we incur in fixed asset as we use them and as they become less useful and less valuable to us, right? But hopefully we're using these assets in the production of revenues, so as they lose value and record expenses, they're also helping us create revenues. Okay? Excuse me. So here we have the data that we're going to be working with over here. And here we have an example. Let's follow these boxes. I know this is a little bit busy. In this box we have our depreciation using straight line depreciation, which is one method. Here we have our depreciation using units of output method, and here we have depreciation using double declining balance method. So you would choose one of these three, and you would calculate the depreciation based on one of those three methods. Okay, so, and I already could see a mistake here because I'm supposed to have residual value here of $5,000. So what's my mistake here? Units of output method. Okay, so this is, I'm using the wrong number here. Units of output is let's see if I do this. Now I got it right. Now I have a residual value of 5,000. Sorry about that. That was a little mistake that I caught and was able to correct immediately. Okay. So anyways, and you'll see why I'm trying to get $5,000 here at the end. Okay, because that's the residual value. So the assets are supposed to end up with $5,000. So let me explain this really quickly. The data here. So we have installation cost of $1,500, transportation cost of $2,000, testing cost of $1,500, and we have additional cost of $250. Appraisal value is $73,000. Our offer price was $68,000, and we eventually ended up buying it for $70,000. Okay, so this line says add capitalized costs. What does that mean? What it means is that there are certain costs that we can capitalize. Those are the costs that are necessary to make the equipment ready for use. So up here I pointed out some costs that we incurred. Of these costs, the first three are capitalizable. Installation costs, transportation costs, and testing costs are capitalizable. This means that rather than expense these immediately, we can add these to the fixed asset price, and then we will go ahead and use that as our total cost for fixed asset, and that'll be depreciated slowly through whatever depreciation method you use. Okay, and so the expense will be depreciated throughout time, throughout the fixed asset, throughout the life of the fixed asset, as opposed to immediately. Okay. Adding additional install costs due to mistake is not capitalizable because that was a mistake. If you go to your book and you read, you could probably find various examples of costs that are capitalizable that you can put into the cost of the asset to depreciate, and those that are not. Okay. So we purchased it for $70,000. We were able to capitalize $5,000 of costs, which were due to installation, transportation, and testing. So our total capitalizable cost is $5,000. However, this machine has a residual value of $5,000. That means that at the end of its useful life, it is going to be worth $5,000. Whether that's due to scrap material or whatever, for whatever reason, it's worth $5,000. And as you can see, that's why I had to have $5,000 here at the end of my schedule, because this is the minimum that the machine is going to be worth. And I noticed that I had $10,000 here, so obviously I knew I had a problem. Okay, so that's been corrected. So my depreciable cost is $70,000. Okay, that's what I'm going to use to calculate my depreciation. I use a very simple start date, 1/1/2015, just to make the example easy. This estimated life, the estimated life of the machine is 4 years, and output in hours is 18,000. This 18,000 is not going to be necessary for straight line depreciation or double declining balance method. It will, however, be necessary for units of output method. Okay, so let's start with the first example, the straight line depreciation. So of the 3 methods, you chose to depreciate your asset on a straight line basis. So that's pretty easy, right? What do? You're going to take the cost of your asset, which turned out to be 75,000. This is the formula for annual depreciation. How we get the 17,500. The 75,000, you're going to subtract the residual value, which is 5,000, right? And then you will divide that by its useful life, and that's why it's called straight line, because you're distributing the expense evenly throughout the years. So let's take the example. So my cost is 75,000. My residual value is 5,000. So my depreciable cost is 70,000. 70,000, and I'm going to depreciate that for 4 years. So every year I'm going to depreciate 17,500. That's very simple, right? So I could prepare a schedule like this. Book value is still going to be 75,000 because that's what you're going to book here. This is what you're going to put in your this is the GL for equipment, 75,000. And then the first year you will make an entry at the end of 2015. Remember, we started 1/1/15, so on 12/31/15 we will book our depreciation expense. Theoretically speaking, I mean, you could do it monthly if you want. Let's do this on an annual basis. So on 12/31/2015 we book our depreciation expense. So how do we book our depreciation expense? Well, here's the entry. Here's the sample entry. Depreciation expense, you're going to recognize the expense here, and you're going to put it in accumulated depreciation. Okay? Why accumulated depreciation? Well, it's simply, again, and you've heard this word before, a contra asset account, right? What do we do with accumulated depreciation? We simply, as I said, it's a contra asset account to the fixed asset. So as the asset accumulates, as the accumulated depreciation increases in value, the net book value of the asset will go down. Here I have this number wrong, right? It was 17,500. Okay? So what's the net book value of this asset? It's going to be 57,500. 75,000 minus 17,500. So our asset has a net book value of 57,500. However, in accounting, we like to keep these separate, and as you can see, there for many accounts we use contra asset accounts. It helps us keep certain transactions separate so that it's easier for us to later on make adjustments and corrections and additions and subtractions too. So in accounting, we always keep our accumulated depreciation. We account for that separately from the account where we put the fixed asset into. Theoretically speaking, you could make the credits over here, and it would sort of work in a similar fashion. But again, we prefer to have them separate in what we call a contra asset account, accumulated depreciation. And in the balance sheet, it could be presented as this. That's not a problem. We could put fixed assets net of accumulated depreciation, and you would point out your accumulated depreciation in your notes or maybe in parentheses on the face of the statement. But this is how we account it for. We account it for with 2 different GLs. Equipment represents the initial cost of the equipment, and accumulated depreciation represents the depreciation that has accumulated up to that point for that equipment. Okay? So, as you can see, it's pretty simple. In this case, we have a book value of 70,000, but we're only 75,000, but we're only going to depreciate 70,000. So 70,000 divided by 4 is 17,500 per year. This gives us our book balance, book value every year, net book value, and then we're going to end up with a book value of $5,000, right? So if I come down here, 17,500, and then let's say I add another 17,500. Let's see if I fix this, if I put this formula in correctly. Yeah. So we have 40,000 net book value, right? So that matches that. And let's say we add another 17,500 at the end of 2017. 22,500 is my net book value. Accumulated depreciation is going to be 52,500. And then our last 17,500 is here. We've depreciated 70,000. Our net book value is going to be 5,000, which equals my residual value. And so as you can see, the equipment GL stays intact, and we accumulate depreciation over here on this side. Okay, so that's quite simple, and this is the entry to book depreciation expense, and it's going to be similar every year, all 4 years. So that was quite simple, right? Let's go to the next example, which is going to be slightly harder, but it's really not that much harder. We're going to do units of output method, and in this example we're going to use the 18,000 hours. So we've estimated that that this machine has about 18,000 hours of use, right? So we want to calculate, well, how much depreciation per unit. In this case, the unit is hours. So how much do we depreciate per hour? Well, that's quite simple, right? You're going to get your cost again, which is 75,000. You're going to subtract residual value, 5,000. So this is your depreciable cost, 70,000. And if you have 18,000 hours, then let's go 70,000, 18,000 hours. So, and this is, you're going to subtract $3.89 per hour used, okay? So here I made up some data as to the amount of hour used in the 4 years. We used the machine for 4,400 hours the first year, and so my depreciation expense is calculated very easily. 4,400 hours, multiply it by depreciation per unit, in other words depreciation per hour, which we already calculated to be $3.89. My total depreciation expense is going to be $17,111. So that would be, here's the entry for that year, and here's my book value, right? And so, you know, every year we do the same thing. As you notice here, we have pretty much an even amount of depreciation expense every year. Here it will fluctuate. We don't know which year is going to be highest. It depends on the hours used. Okay, so in this case, the last year, we used the least amount of hours, and I just, you know, that's just an example. I have no idea, but let's just say the machine is starting to break it down more often, and so we use it less, and so our depreciation expense happens to be less here. It starts going up and then it goes down. It could be whatever, depending on the hours used, right? So if we do the same thing that we did for over here, just to see how it works. So first year, we, at the end of 2015, December 31, we book our first depreciation expense. Here, accumulated depreciation is going to have 17,111. And so my net book value is going to be 57,889, as we can see here. Then the next year, 18,472 is depreciated, and we put it in accumulated depreciation using this same entry. Net book value is going to be 39,417. Then at the end of 2017, we depreciate 19,444, right? And net book value is 19,999. Well, there's a rounding error there somewhere. Yeah, if I link it, it'll probably give me a more equal number, because I'm sure there's cents there, and that's why it's not matching perfectly. So it's better if I link. Let's go ahead and link that. That'll make things adjust more easily. Okay, so now we have a net book value of 19,972. And my last year, I will depreciate at the end of 2018, 14,972. I've depreciated the full 70,000, and I end up with my residual value of $5,000. Okay, so that's the unit of outputs method. Double declining balance method. This method is used, and you're going to, in this method, the depreciation expense is going to be really high at the beginning of the year and go down. And this follows the logic that new equipment tends to depreciate faster early on, and then slows, so the depreciation slows down. For example, we'll use the very typical example that people say. If you buy a car, as soon as you drive it out of the lot, the car will depreciate, I don't know, at $5,000 in value, right? So it immediately loses value, So a machine, they state, will tend to lose more value at the beginning than at the end, because everybody wants a brand new machine coming from the store without use, and they'll pay a premium for that. As soon as it gets used, it starts losing value. So that's the logic, sort of the logic behind this one. Okay, so how do we do the double declining balance method? Okay, so we take the straight line method, 100%, we'll use the percentage. In this case, 100% depreciation is going to be divided by the number of years on the straight line, right? So 100% on the straight line, if you have 4 years, you will be depreciating 25% of your depreciable cost per year. So as you can see here, you're depreciating 25% of the depreciable cost per year, right? So so first you're going to calculate that. So my straight line depreciation percentage per year of depreciable cost is 25%, right? That's step number 1. So you're going to say, well, this is the double declining balance method, so I'm going to double that. So I'm going to depreciate 50% of my beginning of year balance per year. So 25 times 2 is 50%. So now I'm going to, so for double declining balance, I will depreciate 50%, okay? This is a little bit more complicated, right? But just understand, you take the number of years on the 100% of depreciation cost divided by the number of years you're going to depreciate that on the straight line, and that's going to tell you the percentage per year of depreciable cost, and then you simply double that. So in this case, we're going to use 50% as our rate, and you can see that here in this line. And we will start with the full beginning of year book value, which is going to be 75,000. We will appreciate, it's going to be net book value, okay? So since we haven't depreciated anything here, our net book value is going to be, let's put a 0 here, is going to be 75,000 for starting the first year, right? Multiply it times the rate which we already calculated. Our depreciation expense is going to be 37,500. Okay, so that's our expense. We book it. Depreciation expense 37,500. Accumulated depreciation 37,500. So now I subtract that from accumulated depreciation from beginning of year book value will give me my end of year book value, 37,500, right? So we roll this over and start all over again. 37,500 times 50%, which is the rate I'm going to use, is 18,750. So for my next year, my depreciation expense is going to be 18,750. And so my net accumulated depreciation is 56,250, and my net book value at the end of that year is going to be 18,750. Okay? So I roll this over here. Multiply that times 50%. My new depreciation expense is going to be 9,375. I have accumulated depreciation of 65,625. And my end of year net book value is 9375. So I roll this over. So here's where we have a bit of a difference. Okay, so if I were to use 50% here, I would over depreciate and I wouldn't have my residual value of $5,000, right? So if I go, what's 50%? Let's say I use 50% here. Oh, there goes the phone. There's always something interrupting my videos. Anyways, so if I were to use 50% here, let's keep this number in mind, 4,375. So I go 9,375 times 50% is 4,687. And then if I, what's the formula that I had here? Copy, paste down. 4,688, right? That's going to be my end of year book value. But I know that it can't go below 5,000, right? Because $5,000 is my residual value. So I'll work my way backwards. I cannot use the percentage that way. So I'll put the, let me see if I just do this. If I put the 5,000 there, and then I calculate backwards. If I want 5,000 there, I'm going to have accumulated depreciation of 4,375. And therefore, I no longer am going to use the 50% double declining balance rate. And that's only applicable in the last year. So beginning of year book value was 9,375. I could not use the 50% because it would overstate my depreciation expense. It would make my end of year book value higher than my residual value, and that can't happen, right? So I say my residual value that I want is 5,000. That means that the most I can depreciate this asset this year is 4,375. And so that's going to be my depreciation expense for the last year. So keep that in mind. You do not use the percentage rate in the last year unless it turns out to be $5,000 perfect, which you know, I doubt will happen. So this is your last year's depreciation expense. 4,375. Accumulated depreciation is 70,000, and net book value is 5,000. Okay, so these are the GLs, and that's how that works. So I hope this video was very simple to understand. Of course, there's a lot more concepts that you need to pick up, so read the chapter and read the books. There's a couple more things that I can add of value before I leave. Let's just go over here and let's take a look at different expenses. Okay, so after you purchase the asset, you may have various other types of expenses. So depending on the type of expense, you're either going to expense it at the moment, you're going to add it to the value, to the capitalized cost of the equipment, or you're going to use it to reduce depreciation expense, right? So ordinary maintenance and repairs, that's just, you know, oiling up the machine and fixing minor repairs so that it could continue to work. That you would expense in the period because it's just simply ordinary maintenance. So oil and whatever, change a filter or whatever you have to do, you expense it in the period, right? So repairs and maintenance expense would be debited for 500, and let's say you paid cash, you would debit cash for 500. What if you do an improvement to the asset? Not fix it, but actually improve it. So you have an equipment and you went out and whatever, you added something that made it even better than it was before. Okay? So it's very important that you distinguish between improvement and extraordinary repair. In an improvement, you're actually making the asset better than it was before, more useful. It has an additional feature to it. So if it cost you 1,500, then you would put it into the cost of the equipment, the book value of the equipment. You would add it to this account over here. And then you would recalculate your new depreciation expense per year, okay? So you would add that to the equipment value, 1,500, and you would go ahead and credit cash if you pay for it cash. The last type of use of the last type of expense that you use that we know of for fixed assets would be extraordinary repair costs. So in this case, it's not an ordinary repair; it's a major repair. Like it doesn't make the asset better than it was before, or have a different feature than it has before, but it does increase its useful life, and it extends its life significantly. So let's say you had a machinery or a forklift in this case, and let's say you did a major overhaul to its engine, and it's extended its life by an extra year. Well, what you're going to do is you're going to reduce the accumulated depreciation, because it's no longer depreciated by that amount. You have increased its useful life. So by adding a debit to accumulated depreciation, you extend the useful life, and in a sense you also increase the asset's net book value, right? And then you would book cash over here. Okay, so these are three distinctions that you need to know as well. So that's it for fixed assets and depreciation methods. I hope this helped. And there's a lot of other subjects that you need to know about this in the book. So read the book or read the PowerPoint slides. But this should give you a basic idea of the full chapter as far as fixed assets and depreciation methods go. Thank you.